Hello and welcome to part 3 of A Simple Guide to Financial Planning. 3 parts. I know, intense, right? But this is a great guide to give you a foundation to personal finance. And once you have this foundation, you can be put on the path to having peace with your finances and on to freedom. In the first video, I introduced you to Jim Rohn's 70-10-10-10 plan, meaning for every dollar you earn, you spend no more than 70 cents. And then I showed you how to allocate the rest of your earnings towards the expenses that you have. And then you may have found that it's difficult for you to contribute to your future and into your savings. So in the second video, I showed you or introduced you to how to eliminate a lot of the debt and take your focus off the future for just a little bit. Say, for example, like credit card bills, student loans, medical bills, etc. Take care of those, and then you can go back into contributing to your future and into your savings. If you're young, it usually only takes maybe 18, 24 months to take care of all those unnecessary debt. So 2 years is, simple to when you still have 20 to 30 years to make up for it. So then once you are able to eliminate a lot of those expenses, then you can start putting your efforts back into your future, back into your savings, and back into tithing. But let's say maybe you're still too heavy into housing. Maybe you still have a car loan that you're still trying to work on. Maybe 30% of your income is still difficult to work with. Well, if that's the case, well, at least let's get you in the habit. If you can't do 70-10-10-10, then maybe you can do 97 1, 1, and 1, and just start out there. Work with that for a little while, and then maybe you can upgrade it to where you can go 94 2, 2, and 2. And then you start getting the habit, you get really excited about your contributions again, and then you can step it up to maybe 85, 5, 5, and 5. And then what you'll find here is that when you start contributing to your retirement, start contributing more to your savings, and start contributing more to your giving, you start to receive an abundance flow. You start to reap all that sowing you've been putting into. So that's why this top 30% or the top 3% or 6% or 15% is so important to your financial planning strategy. And then let's say you can look for ways to increase your monthly cash flow. Let's look right at taxes, because that's the easiest one that we can look at for now. Because what a lot of people don't realize, like I said in the first video, is that taxes can be anywhere from your second to third highest expense. We always look at our take-home pay, but you definitely want to look at what you're paying in taxes. So to increase your cash flow through taxes, you want to understand, well, how taxes are calculated. And there's a simple calculation for taxes, which is first calculating your taxable income. And calculating your taxable income is simply just taking your gross income minus your adjustments. Adjustments meaning your IRA contributions, your health savings accounts, and many others. IRA and health savings accounts are the most common. And as long as it's more greater than 2%, you can subtract that from your gross income, and then you have what's called your adjusted gross income, or your AGI. And from your AGI, you subtract your exemptions. In a household of 4 for 2015, everyone in your household, including yourself, you subtract $4,000. So in a household of 4, you subtract $16,000 from your adjusted gross income. And then you subtract your deductions. There's a standard deduction, which depends on your filing status, and then there's your itemized deductions. Now, if you're a homeowner, you'll see that your itemized deductions are actually greater than your standard deductions. And then you can deduct your charitable giving. See how taxes really like this allocation strategy here, because it's already getting a tax break on contributing to your future, contributing to giving, and your housing expense, just from that alone. So once you subtract your exemptions and your deductions from your adjusted gross income, you have what's called your taxable income. And then you can look up to see what tax bracket you're in and just multiply your taxable income by the percentage tax bracket that you fall into. Once you have that, you have what's called your taxes due. To reduce that even further, you can look at reducing that through credits, whether that be child tax credits, energy credits, etc. So just from this equation, you can see that you get a bigger benefit from your credits than you do deductions. So speak with your accountant and then find a balance between your exemptions, your deductions, and then your credits to find a net zero, which means get a zero return. Don't look for the refund you get in the spring. This is all about increasing your cash flow. A refund just simply gives the government a 12-month interest-free loan on your money. And if you calculate inflation, you just earned a negative rate return on that money of that refund you gain in the spring. So look for that sweet spot by either adding more exemptions, deductions, credits, or anything like that to get you at a net zero, paying nothing. And just simply become a happy taxpayer, because you'll find that maybe it's even better just to pay a little bit than getting a larger refund, because then you've known you've maximized your income that you've earned throughout the year. So I hope this simple guide to financial planning has helped you as far as your guide to achieving your goals in life. If you have any other questions regarding budgeting strategy or personal finances, feel free to reach out to me. My contact information is at the end. But I'm always looking forward to helping you live with purpose.
I just wanna go back now. I just wanna go back